In May 2026, the United Arab Emirates officially left OPEC. This country controls 7 major state-owned investment funds, with nearly $3 trillion in assets. Dubai is also the biggest financial hub in the Gulf region, so when the UAE announced its exit from OPEC, the global energy market was shaken. But the real story started 2 months earlier. In March 2026, an Iranian missile struck the famous Burj Al Arab Hotel in Dubai. U.S. air defense systems deployed nearby failed to stop the attack because of the overwhelming number of missiles launched at once. That single strike exposed a major weakness in the UAE's long-standing security system. For decades, the UAE depended on 2 major frameworks. Externally, it relied on U.S. military protection and became a key part of the global petrodollar system. Internally, it coordinated regional relationships through the Gulf Cooperation Council and OPEC, but both systems came with a huge price. The UAE poured massive amounts of money into American financial markets and spent billions every year buying U.S.-made weapons. Inside OPEC, it also had to compromise with Saudi Arabia on oil quotas and financial interests. For years, these arrangements worked well enough for the UAE. But after the missile attack, the old order started collapsing. The stock market lost $120 billion in value almost overnight. Bank deposits began leaving the country rapidly, putting pressure on nearly $300 billion in capital. A financial empire built on oil and global confidence suddenly looked unstable within just 2 months. Facing this crisis, the UAE decided it had to break away from the old system. On April 28th, the country announced that starting May 1st, it would officially leave OPEC. From that point on, its oil production would no longer follow OPEC limits. Market confidence improved slightly, and fears of a financial crisis began to calm down. At the same time, the global petrodollar system itself was also starting to weaken. In Middle Eastern oil trade with China, about 41% of payments are now settled in Chinese yuan, while the US dollar's share has dropped to 52%. Meanwhile, in 2025, China's non-fossil energy consumption surpassed oil for the first time, becoming the country's second-largest energy source. Oil is now under pressure from both sides, and this massive shift in global energy is eventually impacting one specific industry more than most people realize: logistics. For commercial vehicles, diesel costs about $75 per 100 kilometers, while electric vehicles cost only around $15 for the same distance. That difference can save drivers $40,000 to $50,000 every year. And for most business owners, calculator math speaks louder than politics. In 2025, China's new energy commercial vehicle market penetration reached 26.9%, with annual sales hitting 871,000 units. Drivers using Wuling new energy commercial vehicles can save a huge amount in operating costs every year. For logistics companies and independent drivers, that extra money becomes pure profit. Diesel is expensive, maintenance is expensive. Gas-powered vehicles also face stricter environmental policies, but new energy commercial vehicles are solving these problems one by one. Range is no longer the weakness it used to be. The latest generation of electric commercial vehicles can now fully handle most city delivery and regional logistics routes. Electricity is naturally cheaper than diesel, and electric motors are mechanically simpler than combustion engines, which means lower maintenance costs and longer service cycles. One company getting a lot of attention in this space is Wuling, because it's no longer competing only on price, it's competing on value. In this new energy era, saving money is important, but making more money matters even more. Lower costs and higher efficiency are becoming the new formula for success. Wuling built this strategy around 3 major technologies. The first is the Shenlian commercial battery system. Commercial vehicle batteries face much tougher conditions than passenger car batteries. They deal with heavy cargo loads, constant driving, high heat, vibration, and stress every single day. The battery pack includes side impact energy absorption protection and an AI battery management system designed to improve durability and reduce long-term ownership costs. The second is the Linksea Power System commercial version. Using a silicon carbide rear drive system, it delivers stronger performance with lower energy loss. With the same amount of electricity, drivers can travel even farther. And for truck drivers, every extra mile means extra income. The third is the Qianyu commercial platform. It was designed specifically around real transportation needs, creating a modular large space structure that balances vehicle size with maximum cargo capacity. Compared to vehicles in the same class, it offers significantly more loading space and better efficiency. Cargo that once required 2 trips can now be delivered in 1. And in logistics, saving time means saving money. Now back to the UAE. That missile strike shattered the illusion of security in the Persian Gulf. The UAE leaving OPEC is changing the global oil supply system and the way oil prices are controlled. The window of cheap oil may be closing, and the cost advantage of new energy commercial vehicles is no longer just temporary government subsidies. The price gap between fuel and electricity will likely continue growing larger. The people and companies that adapt fastest to this new energy economy will gain the biggest advantage in the next wave of competition.